That's what we're doing tonight. Okay, let's take a look here. Did you need a handout? Oh, yes, you do. Okay, let's see here. And do you need the handout though or no? Okay. Okay. Hey, how come that's not turned on? Okay. All right, I think we're getting there. Okay, so let's start in. Hello. Chapter 11 handout. Okay, confirmations. Hmm? The same one as last time.
You didn't bring it.
You didn't bring it? Okay, here we go. There you go. Here you go. Okay. So confirmations. Confirmations are used to improve the evidence, basically. It's, and I think we talked about this last time. When you talk about accounts receivable, you're talking about a lot of documents that are made by the client. The sales invoice, the picking, all this stuff. There is the bill of lading, which is a third-party document. It goes to a third party also. But we want to move that evidence up to being more more reliable, more so for instance, proving the existence of it. So things like accounts receivable, one of the things we do is we send out a confirmation, and the confirmation is to make sure that you'll ask them basically, do you owe this much money? Okay, so a positive confirmation and a negative confirmation. Positive confirmation means that all confirmations must be returned to the auditors, and they go directly to the auditors. They don't go to the client. Okay, so positive confirmation. All confirmations must be returned to the auditor. So that's a positive one. The negative confirmation is only if they are negative. In other words, only confirmations that are misstated need to be returned to the auditors. Okay. So positive confirmation, they all have to be returned. Negative confirmation, only confirmations that are misstated need to be returned to the auditor. So we're only interested in the ones that are misstated. If everything's okay, you don't need to return it. So these are the two type of confirmations that are usually used for accounts receivable. They can be used for other confirmations. You could also use these for accounts payable, but very rarely are they used for that. They're usually used for accounts receivable. Okay, and so this is what an accounts receivable confirmation looks like. The positive accounts receivable confirmation. First of all, this is an important note. We send it out on the client's letterhead. So, for instance, if this is IBM, we'll send out this with an IBM logo on it for this accounts confirmation. Why don't we send it out with just the audit firm name? Why would we use, it's IBM's customer. Why would we send this out with an IBM logo instead of our own CPA firm logo? Anyone?
Can you repeat the question, please?
Yeah. we send out these confirmations. What we'll do is we'll get letterhead from the client. So if this is IBM, we'd put, for example, this would be, um, we might put IBM on there for the, so that we send it out. So we're auditing IBM. We send this out to IBM's customers, and we're going to use the IBM logo. Why don't we use our own? Why don't we use the CPA firms?
Well, the client would need to know that that the audit relates to IBM because they may not be familiar or have any knowledge of the CPA firm. And why would they be reaching out to them?
Exactly. They don't know who we are, most likely, and they certainly don't have any business with us. So if we used our own logo head, it would probably get thrown in the garbage. But IBM, they say, okay, we do have an account with IBM, so IBM, we would use the IBM logo to get them to know who it is, first of all, like you said, but also um, to let them know that this is, coming from IBM basically, and to see if these are all on the up and up. Okay, so we'll have this list of, usually it's a list of it by invoice or however they want to list it, however their sales are made. But this would be a listing of invoices, and we would say, is this amount above correct as of 12/31? So as of the end of the year, do you owe this amount, basically? Yes or no. Now, if it's no, then we say, okay, what's wrong with it? And they'll fill in what's wrong with it, and we'll see what we do with that later. But so they'll return it, and it'll either say yes, this is a positive confirmation, so they all must be returned, or no, they all must be returned. But if they say no, we say, okay, why did you say no? And they'll tell you, well, we already paid this one. We didn't, that's not our invoice, whatever it is. Okay. So that's a positive confirmation. And again, we have to get all of these back. All of these are returned. We'll put it in big, obnoxious letters. Must be returned. So we're going to check on all these, and you're going to call up the people. If they don't send it back to you, you send out 100, you get back 87. You call some people up, you get back 94. You call some people, you get 98. And then you spend half a week tracking down the other two. Okay. So positive confirmation. All of these must be returned. You must account for all of them. You send out 100, you must account for 100 of them. Negative confirmation. Again, we do it on the client's letterhead, send it out for IBM. But then we add something else in here. So here's the invoice we have. And we will say, if the amount above is correct, please disregard this confirmation. So they can say yes or no, but if it is correct, if they say yes, then they can disregard it. If they say no, we want to hear about it back. If the amount indicated is not correct, then please explain the discrepancy below. If the amount is not correct, return this confirmation in the self-addressed envelope to blah, blah, blah. So this one is these are only returned. Oops. Oh, that's right. I'm doing the obnoxious capital letters. Only returned amounts are misstated. So negative ones are only returned if the amounts are misstated. Okay. Which type of confirmation is the best? I'm going to go ahead and tell you it's the positive one. What is the problem with the negative one? What's the problem with the negative confirmation? They only send it back if there is a problem.
Yeah.
I'm sorry?
I said they will only send it back when there's a mistake.
Yeah, so only when there's a mistake do they send it back. There's actually a problem with this one, though. Actually, a couple problems. What might those be? So let's say you send these out. Let's just say any given one of these conversations, you send out this negative confirmation and you don't hear back.
Probably the amount is different on invoice.
Well, it could be that you didn't get it back for a number of reasons. Maybe they tried to send it back, but it got lost in the mail. Maybe they never got it. It got lost in the mail before it got to them. It could be they got it, they read it, go, oh, this is just stupid. And they crinkle it up, throw it in the garbage. And you don't know. So the ones that are not returned, you really can't make a judgment based on those. You can't say, okay, if you get back 5% of the ones, you can't say, okay, the other 95% are okay, because you really don't know for the negative confirmations. So the positive confirmations are the better ones. That leads to the question, okay, why do we even have negative ones? And we'll talk about why we do that. Let's first go to why the best evidence isn't always used. Suppose you have two options. You have option A, you can send out 100 positive confirmations. Or you'll be just as happy if you send out negative ones. Now, to send out negative ones, you're going to need a lot more because the evidence isn't as good. So you would have to send out, say, 500 negative confirmations to be just as happy as you are with 100 positive ones, because the evidence isn't as good. You have to send out more. Which one would you probably end up sending out in this case?
The positive ones.
Probably the negative. Why would you probably, it comes down to cost. Oops, where were we? Yeah, I'm right. That's right. 100 times, so what is it? It's 2,000, right? Okay. And the negative ones are, and you'd be just as happy. It's not as good of evidence, but yeah, you have to say you have to get more of them. But the positive ones are 1,500. So if you're just as happy, you would probably end up going with option B. It's cheaper and you're just as happy. And also notice that at some point, when you're doing an audit, you're charging the client, you have your cost, but you charge a little bit more than that to the client, but you are working with the client's money. So you also have to be, being efficient is also better for your client in that, it reduces the cost of the audit, basically. So you do try to be efficient. And in this case, why isn't the best evidence always used? It's because it's too expensive. Oops, caps off here. So we don't always just get the best evidence. So I would say this is the best evidence. We're going to always use the best evidence because it might just be too expensive to get the best evidence. And if you're just as happy with lesser evidence, but more of it, that might be a way to go. Okay, so the question is, well, when do you use a positive one and when do you use a negative one? Okay, the positive ones are used for positive confirmation. Used for accounts, receivable with larger dollar amounts and fewer accounts. Let me clean this up a little. So things that are more expensive. You know, the larger dollar amount, you know, any one of these accounts might be considered material. Suppose they have, 13 customers that are in the millions. Well, $1 million accounts, any one of those might be by itself, might be a material account. So positive confirmations are used for accounts receivable with larger dollar amounts and fewer accounts. And you can probably guess what the negative ones are, just the opposite. Negative confirmations are used for accounts receivable with smaller dollar amounts and more transactions. And many transactions, let's say, many accounts. Okay. So smaller dollar amounts, so that even if one of them is completely misstated, it probably doesn't matter. It's not going to be material, and there's going to be less problem with it. So if someone does wrinkle it up and throw it in the garbage, it isn't that it's probably not that big of a deal. Accounts receivable miscellaneous stuff. What's that? Okay, so okay, let's see here. We'll hold off on that. Okay. Any questions on these four? So the better evidence is positive. We may not use A because it might be too expensive. Or B, if we have if there are a bunch of accounts with smaller dollar amounts, and if a few of them are not returned that should be, it's not going to be that big of a deal. Now, negative confirmations, again, just to kind of put an asterisk on this, is that negative confirmations, you cannot make any kind of a judgment based on ones that are not returned. So negative confirmations that are not returned do not indicate that the accounts are not misstated. They may have been lost in the mail. They may have been thrown in the garbage. They may have gone to somebody that has no idea what they are, and they put it on their desk and don't do anything with it. Okay, so
Wait, did you say it do not indicate or do indicate?
they're not returned. Oh, do not. Thank you. Confirmation or not, I'm sure there's a better way to say that. Unreturned negative confirmations do not really give you any indication of whether they are misstated or not. Because again, you don't know, the thing with the positive ones, you track them down and you will, eventually come to, get a hold of somebody who's going to do it and actually look at it. And it might take a while, but, and finally at the end, you'll say, okay, the last few. Can you send it to me again? We sent you 3 of them. I tell you what, do you have a fax machine? Okay, I'm going to fax it over to you and you fax it back.
I'm sorry. I'm just one more. So should that say misstated or not misstated? Negative confirmations that are not returned do not indicate that the accounts are misstated
Let
or
me,
is not.
let me redo the whole thing. This,
Okay.
unreturned negative confirmations cannot be relied upon for evidence. So it's not evidence that they are that everything's okay. So if they aren't returned, you can't say, well, everything must be okay with that one. So unreturned negative confirmations cannot be relied upon as evidence. How about that? So unreturned ones do not indicate that they are not misstated. Now, you say, well, okay, why do we send them out? Because the ones that are returned might indicate problems that do occur. You know, if we get 15 of these back and they all have the same problem, it might indicate that there's a problem with internal control. It might indicate that there's a problem with other accounts that we can actually go take a look at and say, okay, it looks like every account that has this, there's a problem with the billing. So we do, for the ones that are returned, we use those for evidence. But the unreturned ones, we really can't make a judgment call on that. We can't say, okay, the ones that aren't returned must be okay, because we don't know why they weren't returned. Okay, sorry about that. I think I told you guys, my wife was an English professor. I'm sure she would cringe if she ever read these. Okay. Constantly miscellaneous stuff. So one of the things we want to know is, so we have these assertions here, and these assertions are what we basically test to for the financial statements. And they are a little bit, they're a little bit nitpicky, but this is what we do, this is when we do our auditing. We get evidence for evidence or occurrence for completeness, the valuation of something. These are all things that we do our auditing for, to see if, so for instance, if they're saying there's a sale, one of the things that we want to do is see, does it exist? They're saying it's a sale, but is it really? Do you want to see if they exist? Do we have all the sales? That's another one. Do we have all the sales? Are they leaving some off? That sort of thing. Okay. Which assertions are aided by the accounts receivable confirmation? So which one of these groups would probably be aided by the confirmations? So we send out a confirmation and we get it back. Let's say they're positive. Let's say positive confirmation. We send them out, we get them back. Which ones of these are we? Do the confirmations probably help?
B.
B is the best. Yep. So the existence or occurrence. So if we get one back, it proves that there is that these probably exist, right? If someone writes back and says, yeah, this is okay, we do all this. Well, that's pretty good evidence. That's coming from a third party, and it's saying that they agree that this is an amount that's that they owe. Even if they get negative ones back, there's still, if they say, okay, well, this one, this is overstated by $500. Okay, that means probably the rest of it is okay. So the existence of it is what we really look at here. Now, the one you got to be careful about is the valuation one. And the valuation one is generally not tested by the confirmations. And they're not tested because you might not collect it. Someone may send it back. Yeah, that's correct, but we're filing bankruptcy next Tuesday, so you're not going to get a dime of it. But yeah, the amount is correct. So as far as the valuation of it, that is really not tested by these accounts receivable confirmations. So existence and occurrence is probably the best one. Okay. This is probably the easiest one on here. Which assertions are aided by the sales cutoff procedures?
D.
Actually, it is B and there's one more.
Oh, I said D.
Yep. No, but these are it is kind of funny the way that they're kind of grouped here. But existence or occurrence. So did the sale actually exist in the current period, for instance, or occur in the current period? And completeness. Do we have all of the sales for the period? So actually, these two are. So yeah, did it occur in this period if it's a sale? And we have all the sales where there's sales that were things that were sent out that we didn't count as sales. So those two are best ones. Which sales and accounts receivable assertions are aided by analyzing the cutoff bank statement?
A.
Probably not. A is like kind of the form and like footnotes and stuff like that of the financial statements.
D.
Which one?
D.
Probably D and could also be B again too. And by the way, and if you're wondering, well, for instance, one of the things you might look for accounts receivable to see if they are actually valid is, did someone pay them after the end of the year? Right? I mean, if there's an accounts receivable for $10,000 and we're not sure if it's a valid accounts receivable, maybe we sent out a confirmation, never got it back or whatever. If they actually paid it, it's and it goes in with the it goes in with the deposits and that, and we see that it cleared and it's on the the cutoff bank statement shows the deposit and without any NSF stuff on it or anything like that. Then that's pretty good evidence that that was a valid accounts receivable. Okay. Accounts receivable confirmations. Oh, are accounts receivable confirmation required by generally accepted auditing standards? Yes. U.S. standards require accounts receivable confirmations. So U.S. standards, they require it. Oops. So U.S. standards require it. Are accounts receivable confirmation required by international? No. International standards. Allow auditors to accounts receivable however they see fit. So they might look at shipping documents. They might look at receipt of cash, after the end of the year. So international standards allow them for verify accounts receivable however they see fit. Now, they certainly can use accounts receivable confirmations, and I would think that many of them do, if not most or almost all of them, but they don't have to. Actually, there was a big fraud that happened because of this. There was an international CPA, audit that didn't verify any of the accounts receivable and or verified it some other way or whatever, and they were all fake. But generally the international standards are a little bit more of, use your judgment, basically. So this one's more auditor judgment. US standards, we say, nope, you gotta you gotta do it. You gotta send out the accounts receivable confirmations unless you have a really good reason. Yeah, you have to send it out. I think I told you guys this though when maybe I didn't. When I was at Navistar, I tell you about that. We made engines down in Indianapolis, diesel engines. We basically made all the small diesel engines for Ford trucks, and Ford would buy 97% of our engines or whatever. We had basically one huge accounts receivable was basically what it was. And that was, we literally would go through all the invoice. There wouldn't be any confirmations or anything. Now, for the other 3% of the customers, we would, you could do accounts receivable confirmations on those. But the Ford account was just the massive one. And that was, we didn't do a confirmation on each one of those. We went through the thousands literally of engines that we sent for them and which ones were paid and which ones weren't and all that. Okay, who should authorize the write-off of accounts receivable? This is going to be a funny answer. Anyone except the accounts receivable clerk, or the Treasury Department. They usually will have a group that will, if they monitor especially if they have a number of these accounts, that they'll have people who will, and they'll determine whether they are going to receive those or not. So the accounts receivable clerk should not be writing those off. Generally, the Treasury doesn't write those off because if you think about it, Treasury could take the money and then, and one more thing. I know there's one more group that can't be. I'm going to tuck it in. The Treasury or Sales Department. So accounts receivable, we talked about the accounts receivable lapping and all that kind of stuff. So the accounts receivable people can't write it off. The Treasury, they handle the cash, so they can put the cash in their pocket and then say write off this account. That would be bad. And the sales department, they're the ones that approve those customers generally and approve the sales. So they are also not allowed to write off the accounts receivable. It's usually somebody not in the line of the actual making the sales or collecting it that we would, that would be responsible for writing it off. Okay. Now, one of the big things, and this is for all auditing, is a lot of times when something does come back, you have to do what they call clearing it. So clearing the notes to an audit. So if there's a problem, whether it's you're doing a test, a test of inventory counts or whatever it is, if there is a discrepancy, they'll also talk about clearing it. How do you clear the notes? And clearing the notes is trying to figure out what happened. And once you figure out what happened, then you may or may not make a suggested correcting entry They actually call them adjusting entries, but I think that's just to be nice. But they will actually make a correcting entry. And for public accounting, they only make it for the material ones. Usually they only, Okay, so let's go to how do we clear these up? Now, I'm going to tell you that a lot of these you can clear up with oh man. Don't I have bill of lading here somewhere? Yeah. Bill of lading is one of the best ones to clear things up to see if they actually something was actually shipped. You might do proof of delivery, might be secondary, but bill of lading shows that they actually shipped something. Another thing that we can look at is if someone says that they paid something, we can go find the check, and we'll talk about that in a little bit. Okay, so let's go through this. Auto step to clear auto receivable confirmation responses as of today. Okay, we never received the last shipment. How do we clear that one to see if it was actually shipped out? Get a copy of the
Proof of delivery? Or
It
the
could-
bill of lading?
bill of lading is probably the most important one. I'll tell you why in a second. And or proof of delivery. Okay, so and why do we focus on the bill of lading? Why don't we focus on the the proof of delivery? Well, the bill of lading tells us that something was shipped. Now, it may have been lost in shipment. Someone may have been stolen while it was being shipped. It may have, the truck caught fire and burned up, whatever it is. So the bill of lading, though, actually shows that the client sent something, and the bill of lading will show what it was to the whoever the customer is. Now, you might also get a proof of delivery. Sometimes they say they didn't receive it, and you get a proof of delivery where they actually had. So it could be that they are mistaken too. But the bill of lading is probably the most important one to prove that something was shipped, that there actually was an attempt to ship something. The bill of lading will show what it was. And again, there may have been a problem with the delivery, and that's usually an insurance issue. If something was stolen or broken or, whatever. But a bill of lading is evidence that something was actually shipped. And proof of delivery, though, like I say, it's not that uncommon to have someone say they didn't receive it, and then you have the proof of delivery, and they say, well, who signed it? Oh, well, Margaret signed it. Oh, Margaret shouldn't sign them. Well, that's your problem. Margaret did, and we have All right. So let's say number 2, about 3,500 of this invoice had been returned on 12/9/23. Okay. This one, I don't think this is more of an inventory one, and this would be you'd probably have a receivable report, a receiving report, I should say. We haven't talked about this, so I'll put this one in. So the receiving department, the receiver will issue a receiving report for anything that is received, and there should be a receiving report for the $3,500 of this that was returned. And you can also ask the customer for a bill of lading. They may think that they sent it, but they didn't. One second. To see if they sent it. If you didn't receive it, the next question would be, did they actually really send it? So you might have to chase this one down a little bit. But if it did end up being that it was received, then there might be a problem with the client's you know, with their, what happens when they receive something back, when something is returned, what happens with it and how does it actually get taken off the customer's account? I think I told you I did an audit one time. We had a warehouse in Canada that I went into work one day. I was supposed to be in the office for like a month, and I go in and work. I was on the road for like 4 months straight or whatever. I go in the office and Wednesday or something. They said, you and yeah, you and Ray got to go up to Canada. There's a did I tell you guys about that? The warehouse that had too much inventory. I don't know if I told you. There was they had a warehouse that when they counted the physical inventory at the end of the year, there was way more inventory than there was supposed to be, which is not usually how inventory works. Inventory usually, if there is a discrepancy, usually it's less. Could be stolen, someone broke it and threw it away, whatever it is. Someone sent out a second one to replace one and no one knows what happened, there's this reason why, and you never have more, no one brings inventory into work. It isn't like somebody's going to bring in a bunch of car parts into work and put them on the shelf. So the problem was the return. When the people return something, it was not getting into the system. And that's what, so yeah, it is possible that there is a problem with when something is returned, how they actually go about putting it back into the system and how they, crediting the customer. In our case, the customers were credited, so they were all happy. We didn't hear anyone complaining about that. But we had all this resellable inventory that was not on our books anymore. Okay. Number 3 is an interesting one. I already paid this on 1/6/2024. The check number was blah, blah, blah. There's something almost humorous about this one. So we're asking them if this was an accounts receivable on 12/31. And they say, yes, I paid it on, I already paid this one. I paid it on 12. So what's a little bit odd about this one or funny about it, maybe? This is actually a confirmation that they owed it. They must have owed it on 12/31 because they paid it on 1/6 of the next year. So this one is actually not a problem at all. Confirmation that it was owed on 12/31. Now, you could check and just make sure that we got the check and all that. You could see if the check was cleared through you could do the checklist. And deposit slip. It wouldn't be on the bank statement. But you could trace it to that, but you really wouldn't need to. This is somebody saying, yeah, we did. We owed that. We owed it and we paid it. Not our order. The entire order from 12/12/23 was returned on 12/15/23. This was another customer's order. Your company is stupid. Now, if they get a lot of those, you may have a problem, but okay. So what do we do with this one? Basically, it's the same thing as receiving report. And if we don't have a receiving report, for the stuff. And by the way, on both of these, there could be an internal document called a return material authorization. I should probably put that in there too. Some companies have these, some companies don't. RMAs. So if there's an RMA, then that they're okay to return it. That's another thing to look for. And if they do use return material authorizations and there wasn't one issued, it could be that there's a reason why. Okay, here's the most frustrating ones you'll get back. This total seems too high. You might say, do we have to clear that one? Yes, you do. If they send it back, you have to clear it. How would you clear this? Don't send this back. This total seems too high. How do you verify what the total amount on that would be? I'll give you one side of it. Match the client's invoice with the what? What's our favorite document?
The bill of lading.
Yep. Now the bill of lading won't have the dollar amounts, and you can check the client's, check the client's invoice to see, whether they billed for the correct amount. But anything on that client's invoice should be on the bill of lading. Again, the bill of lading will not have the dollar amounts on it, but the invoice, you can check it, make sure that everything on there was actually sent, and then go back and verify the pricing of the invoice. So hold on, give me a second here. Oops. So you're going to match up that client's invoice with the bill of lading, and if that matches up and the pricing matches up, then it's some whacked out customer. Don't say that to them. And by the way, one thing clients don't like you doing is harassing the customers. They take a lot of time getting their customers. So a lot of times for a lot of these, if there is a problem, you let the client work it out. You don't call up their customers and tell them they're stupid or something. Number 6, per company policy, we cannot disclose any private information regarding our vendors. Company run by lawyers, no doubt. So they say we have company policy that we are not going to disclose any information about our vendors. What do you do? And again, you have to clear it. How would you verify that whatever we have, whatever was listed on that confirmation, that it was valid and it was shipped and the dollar amounts are okay? What would you do? Probably the same thing for number 5. Go see what the invoices are, match them up to the bill of lading, see if the pricing was fine. You know, you're gonna have to do an alternate. You know, they're not gonna cooperate. So you're gonna have to do some alternate way of figuring out. And then, by the way, this is what the international standards say. You know, if you wanted, instead of sending out and getting these wacky responses back, you can just go to the client's invoice, match it up with the bill of lading, look at the pricing to see if that is matches up with the invoice. And you know, that's another way to verify it. Although I would think that this would take a lot longer to do than simply sending out a confirmation. You know, this isn't bad for onesie, twosies things, but if you want, if you're doing, you know, 300 and whatever of these, this would be no fun at all. Dig through, you know, match up client invoices with bills of lading, and that would be very intensive for a large amount of them. Okay, number 7. What time is it? We're getting near the done with this one. This is actually kind of an interesting one, and one that may indicate a problem. We picked up this order at will call and paid cash. First of all, what is will call? Will call is used when you are selling to local customers usually. So maybe you send stuff all over the world, but there also might be people who are local who don't want to, you know, they don't want to pay shipping or anything. And so what you know, they'll order something and they'll say, well, you know, we're going to send over, you know, Tammy's going to come over in the pickup truck. Oh, unless we make this into a question. No, not a question. Will call is used when selling to local customers. And so, you know, usually local customers will just, you know, they'll put whatever it is that they're going to go pick up, they'll put it in will call. They'll go, they say, we got something to pick up. We know they have their customer IDs and all that kind of stuff. And some, you know, they may pay in cash, they may just be regular accounts receivable for the client. But that's when they pick it up. Okay, so someone went to will call and paid cash, and they gave a copy of the receipt. What's the problem here? What would you want to know about this one? They
How much they paid?
well, yeah, what happened to the cash? You know,
Yeah, but he could to just, put it in his packet with the receipt.
yeah, because they put it on the books as if it had not been paid, but obviously they gave a copy of the receipt when it would, you know, I'm sure would indicate that it had been paid. So the question is, how did this happen? You know, this might be an internal control issue. It could also be someone, you know, that misappropriating an asset, which is like theft of an asset. So this could be a control issue with the cash. It could also, you know, part of it could be that maybe they don't get very many cash receipts and that they don't, you know, they didn't know what to do with it. You go and ask them, they go, oh yeah, it's sitting in a drawer. $2,300 sitting in a drawer. So it could be a control issue with the cash receipts and or accounts receivable. So, and the big question, the question is what happened to the cash and, where is it? But also to see why wasn't it, why was there an accounts receivable that automatically got generated supposedly? So it could be a control issues over. Okay, let's stop here and take a break. Is this the last thing we have? Okay. So we'll stop here. Yeah, and these are, I can tell you clearing stuff like this is one of the, if you're wondering like what takes a long time for auditing, it's clearing stuff like this. It's a nightmare. You're dealing with all kinds of people and. Yeah, yeah. So let's say be back at, sure. Okay, I can't remember if this, I don't think this was actually a CPA. I think this question came off a CPA review. I'm not sure if it was ever an actual CPA question. But anyway, this is a sales journal versus bill of lading problem. And so basically, here's the sales journal, and they show the dates on it. And so from the last dates on the sales journal, we would come up with this would be the total amount that would be in our excuse me, our sales, our cutoff for the sales for the 31st, whatever those are together. Okay, so they're saying that the sales in the last day would be, oops, 4,800. Is that right? 28, yeah. No, that's not right. Well, I said it right. I put it in wrong. Okay, here's the, so this is what they would say that from that last day of sales, those would be the ones that would show up on the books.
It's a 4,800.
How much is it?
4,800.
You're right, it is 4,800. That's on my calculator. I was testing you guys and way to come through. I didn't doubt it for a minute. All right. So there's 4,800 that they'll have for the sales, and then they show these other ones as being from the next day. However, we go to the bill of lading and they don't necessarily match up with what they have. Okay, so 782 matches up. Let's make these green. How about? Okay, so this is what our bill of lading shows us being going out. 783. Wait a minute. 82. Yeah, okay, so this is 82. 3783 is this one. No, 3784. That one. And 3785 is this one. Okay, so 3787. This one was not actually shipped out on 12/31. So the question is, how do we have to adjust these books based on the bill of lading, what was actually shipped out? And what we do is add them up for these and then compare it to what they have. So 3782, I'm going to move our one. This was 700. 83 was 800. Oops. 784 was 1200. And 3785.
Well, 3785 has the incorrect date.
Well, these are the bill of lading. So this one, it was actually shipped out. This is what these are what we'll confirm with a third party. You know, the trucking, whoever, so this is a third party confirmation.
Okay.
Now, again, in their sales register, they may have that these sales were made on these dates. However, for whatever reason, they either didn't get shipped out or, you know, it got shipped out before it got put in the sales register for some reason. Maybe it was some kind of rush order or something that they didn't put until the next day or whatever it is. But the bill of lading are the third party. These are the ones that we're gonna check with to see if they are, what has actually been shipped. So these are the ones that were actually shipped out. And so this comes out to. You guys probably aren't trusting me anymore with this calculator, are you? All right, I should be able to do these in my head. I think I told you guys when I took the CPA exam, they didn't let you use calculators. Actually, in your accounting classes, they didn't let anyone use calculators. That was cheating. All right, 3,100. So, which invoices should be included? Well, so these are the invoices that should be included. And maybe this is probably a better way to do it. I'm just getting extra space in here. So this is what they should have. And so what would the correction be at the end of the year?
Would it be the difference between the 3,100 and the 4,800?
Yeah, so the book has 4,800 on it. Oops. And that is too high by,
$1,700.
is it 1,700?
Yes.
What would be the correction? It's 1,700 overstated, so it'd be reduce the amount of, reduce the sales by 1,700. And one of the things is that about sales is that you generally only have those for what's been actually shipped. If it hasn't been shipped, then it isn't a sale. If it has been shipped, like even this one that's recorded on the next day, it's been shipped already. And if you think about it, they can't sell that. It's gone. And it won't be in the ending inventory either. Whereas this one, whatever was for this one will still be in ending inventory. Okay, go ahead and do the second one there. And while you're doing that, I'm going to send out. So go ahead and work on, I'm gonna stop sharing. I don't like sharing videos. All right, I gotta send out the multiple choice questions for this. Okay, let's see. Share my screen. Okay. So again, we're gonna have the same situation as before. This is 2,400. You know, when I was a kid, they really didn't have calculators. I mean, they had like adding machines. They didn't really have calculators though. And I remember the first one I saw, a kid brought it to school. His dad was an engineer or something. It was in Rockford, which is kind of like Detroit. Um, and and the dad came with it because it was literally worth like, you know, more than like it was like worth a half a car or something. It was very expensive for the time, like $1,000 or something like that. Back when you could get a new car for like 2,500. Okay, so these are the ones that actually cleared. So let's see, this is this one. This one and this one. And by the way, one of the things that you do as an auditor is you go to the last bill of lading, you do a cutoff on the last bill of lading. And that will usually be the cutoff for the sales. And you got to remember that this is actually very important for a number of things. Sales, accounts receivable, and inventory are all affected by this. Okay, so these are the invoices we should have. Hmm? And so what is that? How much is it?
26.
So,
Yeah. 800.
Yeah, 2,800, right? All right, so this, well, this is actually different than the other one. This one says that they are what, their sales are understated. What's the wording I had up here? Okay, so the book was 2,400. And they should have been 2,800. So these are actually too low by 400. So these are understated. Is on there? So, well, correction, they'd be, tell them to add $400 to the sales and accounts receivable. And remember that this stuff will be taken out of inventory. This is a situation where you say, okay, well, you know, gee, that's, you know, they were understated. That's not a problem. The problem is that, you know, it'll look like there's inventory that is missing because it's gone. And you think it's there, but it's not. And so you know, you would it'd be a problem with the inventory too. Okay. Let's go to, I'll do a multiple choice. And let me start a poll. I didn't give you guys a. Okay. My spacing is a little bit wacky on this. By the way, those of you playing along at home, did you guys get the poll, did the poll come up or no? And did you receive the multiple choice questions?
Yes.
Okay, thank you. And again, when you're filling it out, well, for whatever you put anything in for 7, 8, and 9, 7, 8, 9, 10, because but they just won't be counted. Yeah, okay. See where we're at with this one. Are you guys done? What'd you get for number one?
You ready for the answers?
No. We're still waiting on some people to turn it in. I'm asking in the classroom just so we can get everybody included.
Okay, popular is B.
Okay, is anyone in Zoom or anyone still working on them?
I'm almost done.
Okay.
Thank
Okay, is anyone else on the Zoom meeting still working on it? If you can also put it in chat if you don't want to direct message me. Anyone still working on it?
Completed.
I'm sorry?
Mine's is done.
Okay. All right, I'm gonna end the poll then. And share it. Okay, showing results. Okay, let's go through here. Actually, you guys did pretty good. Which of the following is simply not considered? You notice that the first three here all have to do with sales. Oops, where am I at? These all have to do with sales. This one doesn't have anything to do with sales. So accounts receivable. So so D, we actually have two of them on the ground here. So that's makes this three. So D is it, and we get that one. Okay. Number two. Which of the following is likely procedure to test the adequacy of allowance for doubtful accounts? B, actually with one we have here, B and C are a tie. I'll give it to you guys, but aging accounts receivable tells you the adequacy of it. Yeah, the confirmation of receivables, it shows that they exist, but you don't know the value of it. They may not be able to pay it. So the aging of accounts receivable is the correct one. Okay, three.
Yes.
A bunch of them are B, and that is yes. The positive ones are used for large balances. Negative ones are used for. Didn't mean to do that. Negative ones are used for small balances. Okay, number four. Oops, I'm on the wrong page. Hold on. Four D. The inference drawn from the seal of no reply may not be correct. Yeah, and they really tell you not to do that. You shouldn't do that. Now, B is also one that is true, but that goes into this down here. It could be because they didn't receive it. It could be because they sent it to the wrong, there was lost in the mail. It could be, there's all kinds of reasons why. So the best, you notice it says with a best argument. If there wasn't anything else there, if C, or excuse me, if D wasn't there, then probably B would be it. But since D is there, it is the best. Okay, 5, tracing the sales journal, the shipping documents, occurrence of the transactions. That is true, and we have all three of those in this one. So, and so far, one more, and you guys get all the points. And what type of transaction are they looking for? If they're looking for stuff that it was shipped in January and recorded as sales, they're looking for yeah. Accounts receivable is overstated. It could be sales are overstated, but they'll give us that. Well, those go hand in hand. But the accounts receivable are overstated. They were showing that they weren't shipped until January, but we're counting the sales. Everyone who played along gets a
I'm wrong. I was wrong in fun too.
Okay, let me download the results. Oh, now I gotta go find them. Where they download to. Okay. All right, let me let's see, file save as. That's 11. Okay. All right, so let me. And then we're going to finish up. Nope. The sampling overview. So tested controls. All right, so we testing controls because we want to rely on them. You already do this? No.
No, the last vision.
Okay.
Halfway.
Oh, you may not have that one. Do we? Sampling. You need it? Yes. All right, so sampling overview. And we kind of been through this up here. So tested controls are, they're the same, they're basically the sampling is the same as we do for the dollar value. And what I mean by that is, we're going to have you have the same bell curve thing. It's the same kind of, it's a bell curve thing, but it's going to be in percentages though, rather than dollars. So, you're going to have an upper limit, but the upper limit will be in, whatever it is. So if you said, okay, that there's, 2% of these are going to go bad and your allowance is 3%, then the upper limit would be 5%. It's the same thing as we did before, but you're not going to have, let me make this a little better. So if you said this is 2% and this is 3% for the allowance, say, okay, so that the upper limit would be that these are off by 5. It's the same thing as this, instead of using dollars, you're going to be using the percentages that they're off by. And you want to rely on the controls, but the question is how many errors are you going to accept in the controls that you still rely on? And if you can't rely on them, then you have to do more testing, more dollar testing. You want to rely on the controls because it can reduce the substantive testing, the testing for dollars. The better the controls, the fewer items you need to take. But at some point, you can't, if you can't trust the controls, then you have to just do more testing of the dollars. Okay. Test controls, blah, 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 attribute sample, we already talked about. Okay, so for example, this is a control. Manager, a client may have a control that requires 2 managers' signatures on checks written for more than $5,000. Okay, so there has to be 2 approvals on this check if they're more than $5,000. And the idea is, for big dollar amounts at least, you have to have a second set of eyes looking at this stuff. So someone else has to look at the check. You don't just write checks for $5,000 or more, or for more than 5,000, I guess the way it's written. That somebody else has to look at this and approve it. Okay, so how do they test it? Well, they grab a sample of checks for more than $5,000. And they say, okay, we're going to look for these checks and we're going to see how many of them have the 2 signatures like they're supposed to, or they don't have 2 signatures, only have 1 signature. So it's a yes, no test. 2 signatures, yes. 1 signature, no. Okay, so the auditor chose a sample of 200 checks. the auditor will allow for an error rate of up to 7%. So the auditor says, okay, if it's, up to 7%, it's okay. If it's over 7%, it's not okay. The allowance for sampling risk is 3%. Actually, that's what I put on the board. I didn't do that on purpose, but they're saying that 3% will be the allowance here. So we don't know what this is yet, but the allowance is 3%. Whatever this is, we don't know this yet either because we don't know. So whatever our error rate is, we're going to add 3% to that and see if it's still okay. Is someone at the door?
Oh, the water.
Oh. Okay, so 200 checks and 4 of them only have one signature. So what's the error rate? Oops. So we get our sample of 200 checks. 4 of them only have one signature. So what is the error rate? Yep, good. Hey, you know what? It was exactly like I have up here. I didn't do that on purpose. But kudos to me for doing that. No, okay. Okay, so we have 4 errors out of 200. So that equals 0.02 or 2%. It is. It's exactly like I had on the board here. How weird. I got something right. See you guys. What are you guys saying? All right. So this is kind of like what we're at. So it was exactly like I had up here. So the error rate was 2%. It's a percentage, by the way. That looks like a percentage of little eyebrows. Okay. Here we go. So it's 2%, and our allowance, so we're saying, okay, now this is a sample. Our best estimate is here. Our best estimate is that it's 2%. That's the best. But because it's a sample, this allowance of 3% might also be there. So the upper limit on this would be the 5%. Like it's the left there. You actually left it up there. So this is our best estimate. It's off by 2%, but this is a sample. So we're saying that it could be off by 3% more. So the upper limit of what this could be off by is 5%. And let me go back to the paper. Okay, so from the results, the test controls, would they, let me put down what I put on the board. Okay, so the error rate is 2%. 2% plus our allowance for sampling risk is 3%. And so this equals our upper limit of 5%. Okay, so this is our upper limit. This is what we think it could be off by as much as 5%, according to our sample. Now, the auditor allows for an error rate of 7%. So, from the results of our test of controls, would we rely on the assessed risk for the client? We're saying that it could be off by 5%. We're happy if it's off by 7% or less, obviously. So would we rely on the controls? You think? So our sample says it could be up by 5%. We're saying that we will allow for a rate of up to 7% and still be happy. So will the auditors rely on the assessed control risk for the client?
Yes.
Yep. Yeah, it's less than. It's less than our error rate that we would, we'd allow for. So we would rely on the controls. We would reduce, whatever we chose to reduce our substantive testing by, we would stick with that because we can trust the controls, and that's why we did this test in the first place. So because we can test the control or trust the controls, we're happy, and then we will rely on the controls. Okay, now there are risks involved here, and let's see what this looks like. Okay, so this is kind of a logic table or something, I don't know what you want to call it, but we have what the auditors assess the internal controls at. But over here, we have the thing that we may never know, and that is the actual effectiveness of the controls. Okay, now, if the internal auditors assess internal controls as adequate, and they actually are adequate, well, that's good. That means we're in agreement with what the true amount is. So this, let's say correct. So this would be the correct, that our sampling of our test controls, it matched the population as a whole. It gave us the correct result, man. Whatever, if we're at the 95% level, whatever it is, and same thing here for inadequate. So suppose that we say that the controls are inadequate, and they really are inadequate. Well, that's okay too. These two will both give us the correct amount. Okay, now, suppose that we come up to the conclusion that the controls are inadequate. We take our sample and it shows that we can't trust the controls. When actually the controls are adequate, in reality, they are adequate. But for whatever reason, our test doesn't show that. Our test shows that they are inadequate. So this would be we would have a under reliance on internal control. So we won't trust the controls, even though we should. But and you gotta remember, if we're doing an audit, let's say we're auditing at the 95% level, that means 5% of the time you're gonna be wrong. And there's nothing you can do about that. That's just the way it is. If you're auditing at the 95% level, 5% of the time you're gonna be wrong. Okay, so what we're gonna do is do more testing on the dollar amounts. So this will lead to an inefficient audit. We're going to do more work than we really need to because we didn't rely on the controls when we could have, but now our testing, for whatever reason, our sample said, don't rely on these controls, even though we should have relied on them had we had all the information, had it not been a sample. Okay. Now, suppose we say that the internal controls are adequate when actually they're inadequate. So we pick a sample that just happens to show everything is okay when actually it's not okay. It just happens to be the ones that we pick, you know, that 5%. So this will be an over-reliance. On internal controls. This is what we would call an ineffective audit. Oop. It's still ineffective. Factory meaning, what? How was it highlighting that? Okay, so this is an ineffective audit. We think we're relying on the controls. We reduce our substantive testing because we think we can rely on them. But actually, if we had all the information, we wouldn't be able to do that. It's an ineffective audit. Which one of these is the bigger danger? Which is the bigger danger, the under-reliance or the over-reliance? The over. Yeah, you think everything's fine and it's not. You don't know anything's wrong. This one down here, you think things are wrong when they're really okay. And you do some more testing, you do some additional testing. It's inefficient, but you know, it's you come up with a correct conclusion. I know I'm over here, but we'll finish this up shortly. Okay, so this is for the tested controls. Now we also do the same thing for the dollar testing. And you guys remember we did the classical sampling. You know, I think I'll hold off on the sampling exam till next time. Yeah. I'll send out the chapter 11 exam. Okay, so classical sampling. You know, we didn't do monetary unit sampling. It's just a different kind of sampling. But these are to get the dollar amounts. These are what they call substantive procedures. And substantive procedures are for getting the actual dollar amounts. Oops. And so substantive procedures are for finding material misstatements. These are what we use to find material misstatements. I want to say one more thing about the tested controls. If the controls are bad, it doesn't necessarily mean there's a material misstatement. You could have bad controls and have the financial statements be perfectly, you know, reliable. So remember, these are not for dollar amounts. So these tested controls, if you have a problem up here, tested controls, even if the controls are bad, it doesn't necessarily mean the financial statements are misstated. Everything might be okay. You know, they just have bad controls. But down here is where we actually find the material misstatements, and this is where we do the sampling. Okay, so same thing as before. Just did something stupid. Okay, so if they are not materially misstated, and we think they're not materially misstated, again, this is our correct, you know, what we came up with was correct. Our evaluation of, you know, our sample came up with the correct result. And same thing here. If we're saying they're materially misstated, and they are materially misstated, okay, that's good also. If we say they're materially misstated and they're not, this leads to an inefficient audit, because this will usually have us do more testing. So you know, if you do come up with a sample that shows something materially misstated, you generally don't go running in and accuse them of fraud. You generally take a bigger sample, get more information on it. And you do more testing, and usually you should find out if it's, if it is actually materially misstated. And this is, again, leads to the inefficient audit. Eventually the client will say, look, we didn't, these are not right. Everything's fine, I don't know where you're getting these numbers from. And you go around until you do more testing, and you'll come up with the right answer usually, because the client does not want you to say that they're materially misstated. Okay. If you think they're not materially misstated and they actually are, okay, this is a problem. So this is that it is the material misstatement is unknown. To the auditors. And this is an ineffective audit. And like the other one, the ineffective is the worst one. And this one is even worse than the test of controls ineffective, because this one is when a material misstatement could show up on the financial statements and you wouldn't know anything about it. So a material misstatement is unknown by the auditors and it leads to an ineffective audit. And this is the most dangerous one of all of them, even worse than this one. This ineffective audit is, is one thing, but this is, if it is materially misstated and we don't know about it and we say everything's fine, that's the one that was going to keep you up at night. Okay, so there's a relationship between test controls and substantive testing. And the relationship between these is the, you want to rely on the controls. And that's why you do test the controls. You test the controls so that you can rely on them so you can reduce your substantive testing. Suppose the initial test of the test of controls indicate that controls cannot be relied upon. What should the auditor do? So you're doing test of controls because you want to reduce the substantive testing, but as you start your test of controls, you realize that you can't rely on them. By the way, as a side note, as an auditor, you run into that situation a lot. When you're doing testing, I can't tell you how many times, you start doing the testing, and if you pull 80 items and you get through the first 25, and if they're all correct, you go, okay, I know where this is going. There's not going to be a problem. They got their ducks in a row. But on the other hand, if there is a problem, I have time, you get to 25 and you already have 11 of them that are messed up. You go, okay, we can't rely on this. So a lot of times when you get partway through, you kind of know where it's going. So let's say you do this, you do your test of controls, and the initial tests indicate the controls cannot be relied upon. You go through the first however many of them, and you say, okay, we're not going to be able to trust these internal controls. What do we do? Do we increase the test of controls, or do we increase the substantive testing? These are for the dollar amounts. So these are to rely on the controls. So we figured out that we cannot rely on the controls. Which one of these are we going to do? Are we going to increase the test of controls or increase the substantive? Which one? Yep, good. We're going to increase the substantive. We can't rely on the controls, so we're not going to waste any more time with those. We're going to stop those and concentrate on the dollar amount. Okay, we wanted to rely on the internal controls. That's why we were testing them in the first place. However, we figured out we can't rely on them. There's no reason to do any more testing on them. So we'll just do more of the dollar amounts. So here is the relationship. Where am I at? So test the controls and substantive testing an inverse relationship. So it's an inverse relationship. You do more of one and less of the other. If you can rely on the controls, you'll do more of the controls, less of the substantive testing. If you can't rely on the controls, you'll do less of the test of controls and more of the substantive testing. Try to make that a capital. So it's an inverse relationship between those two. Question on that? Okay, I am going to send out the chapter 11 exam. I'm going to postpone the practice exam on this. Which one? Yes, yeah, so, and let me pull that up. Oh, no, that's not it. Okay, so it'll be next. Oh, by the way, no class next week. So no class. I saw that.
It was typo, nobody else.
So I'll send out I'll mail. I do have the test with me. I'll see you guys in the classroom. I will email the exams to those of you on Zoom. They will be emailed shortly. Probably like within let's say by 10 o'clock, certainly. I'll email the exams. They are due. I'm going to back up the due date too, because I don't want to ruin your holiday. It's due on Friday, 12-6. So it'll be due the Friday after we come back. So they'll give you an extra week on it. So I'll email the exams by 10 p.m. tonight. Those playing along here, we'll have them immediately.
Is that the last exam?
I'm sorry?
Last one, exam? One more?
2 more. Yeah. 2 more exams. The sampling exam and then the inventory and property, plant, and equipment. The chapter 12 and 13. But yeah, we're getting to it. It's coming fast. Okay, so this will be I mean these by 10 p.m. I should have these out. It might hopefully sooner, but okay, any questions? No. Okay. I will see you guys next week, and I apologize for going long tonight. All right. Good night.
No worries. Have a good Thanksgiving.
Oh, we will.
Have a good Thanksgiving, y'all. Thank you, Professor.
Thanksgiving.
Have
Happy
a good one.
Thanksgiving.
Good night.
Good night.
Bye-bye.
Good night.